Imagine a country that can buy the world's goods, energy, and technology using nothing but the currency it prints itself. Oil, microchips, automobiles, clothing, grain, and even pioneering tech all flow seamlessly into its market through this single currency. Its global financial balance sheets keep expanding, yet international trade simply cannot function without it. It is woven into the fabric of global trade contracts, held in the reserves of central banks, listed on the balance sheets of multinational corporations, and felt in the everyday exchange rate anxieties of people worldwide. This is the US dollar. Many call it America's super privilege. When a nation's currency becomes the bedrock of the global economy, it possesses far more than just money. It holds the keys to the entire global financial order. Yet, as the saying goes, every gift of fortune comes with a price tag attached. The dollar's first major trade off is known as the Triffin Dilemma. What exactly does this mean? Simply put, when the dollar became the global currency, the United States was forced to balance two inherently conflicting mandates. The first mandate is to ensure the world has an adequate supply of dollars. If global trade, energy transactions, cross border loans, and foreign exchange reserves all require dollars, non US nations must find ways to acquire them. Where do these dollars come from? The most direct path is to export goods and services to the US in exchange for currency. Consequently, the United States must run persistent trade deficits, injecting vast amounts of dollars into the global financial system to serve as the lifeblood of world trade. Of course, trade deficits are not the only channel. Dollars also flow globally through foreign direct investment, bank loans, financial markets, central bank swap lines, and capital flows. For the average observer, the dynamic is simple. American consumers buy global goods and dollars flow abroad. Then comes the second mandate. It is not enough for the US to distribute dollars. It must also maintain the absolute integrity and trustworthiness of the currency. As central banks, sovereign wealth funds, and financial institutions accumulate massive stockpiles of dollar assets and U.S. treasuries, a fundamental question arises. America has accumulated so much debt, can it truly fulfill its obligations? If the supply of dollars is too tight, global liquidity dries up. If it is too loose, the world loses faith in the currency's backing. This is the crux of the Triffin Dilemma. As the global anchor, the dollar must flow outward, but the more it flows, the heavier the strain on its underlying credibility. It must simultaneously serve domestic economic policy and the stability of the global financial system. It must be both a national currency and a global currency. And these two roles are inherently at odds from the very start. As history shows, the United States ultimately chose to sustain the dollar's global dominance. This choice unlocked immense benefits. It allowed the U.S. to finance its debt at remarkably low costs, purchase global commodities with its own currency, and establish U.S. treasuries as the world's premier safe haven asset. Yet, the long term trade offs have steadily come to light. When a nation can continuously exchange financial assets for tangible, real world goods, its economic structure quietly shifts. Imports become cheap, offshoring becomes profitable, Wall Street's financing power intensifies, and global expansion becomes highly attractive for multinational corporations. Meanwhile, domestic manufacturing, particularly low margin, labor intensive industries prone to outsourcing, begins to experience severe strain. To be clear, the hollowing out of American manufacturing was not caused by a single factor. It is the result of a complex interplay between globalization, automation, corporate profit maximization, wage differentials, trade policies, a strong dollar, and the financialization of the economy. The dollar is not the sole culprit, but it undeniably accelerated the trend. A strong dollar makes imports cheaper while rendering American made products more expensive on the global stage. Simultaneously, capital markets increasingly favor light asset, high margin, and highly valued business models. Consequently, the U.S. economy grew exceptionally dominant in finance, technology, branding, and capital allocation, while becoming increasingly disincentivized to retain low and mid tier manufacturing at home. When wealth can be generated with a few keystrokes, debt issuances, and financial engineering, allowing you to import cheaper clothing, appliances, steel, and components from across the globe, the incentive to work on a factory floor, smelt steel, or manage low margin manufacturing evaporates. As a result, Wall Street financiers and Silicon Valley tech elites generated staggering wealth. Meanwhile, the vast industrial heartland that once formed the backbone of American economic might slowly decayed into the Rust Belt. Blue collar workers lost stable employment, communities lost their industrial anchors, and the wealth gap and regional polarization widened significantly. Thus, the dollar's global hegemony does more than just shape international markets. It fundamentally reshaped America's own domestic economic landscape. Subsequently, a highly unique global loop emerged. As globalization accelerated, companies optimized for cost, profit, and supply chain efficiency. Domestic headwinds in the U.S., including labor costs, union dynamics, regulatory compliance, and profit pressures, made certain manufacturing sectors ripe for offshoring. Capital naturally gravitated toward overseas markets, particularly Asian economies boasting vast labor pools, robust infrastructure potential, and export driven policies. Over the past few decades, American consumers used printed dollars to purchase an unprecedented volume of cheap goods manufactured in Asia. Exporting economies like China, Japan, South Korea, and Vietnam gained massive order volumes, employment, foreign exchange reserves, and opportunities for industrial upgrading. Upon earning these dollars, these nations reinvested a substantial portion back into U.S. financial markets, particularly the U.S. Treasury market, to preserve value, mitigate risk, and manage their own exchange rates. An extraordinary self reinforcing loop emerged. Asian factories produce the goods, and American consumers buy them. Asian exporters and financial institutions receive the dollars and immediately plow them back into U.S. sovereign debt. America benefits from low cost consumer goods and cheap financing, while Asia secures economic growth, job creation, foreign reserves, and a steadily advancing industrial base. In the short term, this was a symbiotic globalized cycle where both sides achieved their objectives. In the long run, however, this loop enabled export led economies to build unparalleled industrial capacity, ultimately positioning them as formidable competitors to the United States. Capital follows incentives. It does not inherently protect the interests of a specific nation, region, or workforce. It pursues maximum returns. By shifting manufacturing, supply chains, and technological learning opportunities overseas in search of lower costs and higher margins, capital inadvertently exported future competitiveness. Decades later, the U.S. looks across the Pacific to find a competitor with an extraordinarily comprehensive industrial ecosystem, immense manufacturing capacity, and highly mature supply chain coordination. This did not happen overnight. It is the collective product of the dollar system, globalization, capital mobility, and structural industrial shifts. History demonstrates that global reserve currencies are not permanent. They rise and they inevitably fall. The Dutch financial hegemony succumbed to war, fiscal strain, and credit crises. The British pound was unseated by two world wars, a severe drain on gold reserves, the dismantling of its colonial empire, and the meteoric rise of the United States. Today, the US dollar will certainly not collapse overnight. Rome was not built in a day, nor will it fall in one. Yet, the dollar system is undeniably facing new structural pressures. The first pressure stems from the growing tension between weaponized finance and geopolitical trust. Historically, nations willingly held dollar denominated assets because they were safe, highly liquid, and universally accepted. However, in recent years, the increasing frequency of financial sanctions, asset freezes, and payment network restrictions in international conflicts has forced countries to confront a fundamental question. Are sovereign reserves purely financial assets? From Washington's perspective, financial sanctions are a legitimate tool to safeguard national security and enforce international order. But from the perspective of non Western nations, it signals that dollar assets are no longer neutral financial vehicles managed solely for yield and safety. They now come with geopolitical strings attached. This does not mean nations will abandon the dollar overnight. The reality remains that no other asset market currently matches the depth, liquidity, and systemic credibility of the US dollar and the Treasury market. Yet it shifts the long term trajectory. An increasing number of countries are diversifying their reserves, establishing alternative payment systems, and raising their allocations of gold, local currencies, or non dollar assets. This shift is not driven by an immediate loss of the dollar's intrinsic value. Rather, it is driven by risk management. Nations in an increasingly fractured world are baking political risk directly into their reserve calculations. De-dollarization has ceased to be a purely economic debate. It has become a strategy for sovereign risk mitigation. The second pressure arises from structural shifts in global energy and industry. Following the collapse of the Bretton Woods system in the 1970s, the dollar decoupled from gold. Yet it did not lose its central position. Instead, it successfully anchored itself to global oil trade, the U.S. Treasury market, and America's overarching national might. Oil was the lifeblood of the industrial age. For decades, global energy trade relied almost exclusively on dollar pricing and settlement. As long as the world required oil, the world required dollars. This served as a primary pillar for post gold dollar hegemony. Today, however, the foundational resources of the global economy are becoming far more diversified. Oil remains vital, but the frontier of geopolitical and economic competition has expanded far beyond oil alone. Electric vehicles, energy storage, semiconductors, artificial intelligence, compute infrastructure, critical minerals, and advanced supply chains have emerged as the defining variables of the new industrial era. Historically, a nation's energy security depended on oil, natural gas, and maritime shipping lanes. In the future, industrial security will hinge on semiconductor fabrication capacities, compute resources, battery materials, lithium, copper, rare earths, and control over critical supply chains. The profound shift is that the world supporting the dollar is fundamentally changing. In the industrial era, the oil trade consolidated global demand for the greenback. In the era of renewables, microchips, and AI, global resource competition will be far more decentralized. If more nations adopt local currencies, bilateral clearing, or multilateral payment frameworks for energy, minerals, and commodities, it will not overthrow the dollar immediately, but it will establish robust alternative channels. The dollar system is not facing an abrupt collapse. Rather, it is facing a slow, pragmatic transition. But in certain regions, specific transactions, and critical strategic resource domains, it is no longer the only choice. The third shift is the diversification of payment and clearing networks. It is often said that the dollar's power relies entirely on SWIFT. While accurate in spirit, this requires technical precision. SWIFT itself does not clear or settle funds. It functions as the global financial messaging network that transmits payment instructions between banks. The actual capital moves through underlying banking accounts, clearing infrastructure, and corresponding financial systems. Access to this network guarantees seamless integration into the global economy, while exclusion severely cripples a nation's cross-border payment capabilities and international trade. Today, several countries and financial consortia are developing alternative payment networks, seeking to bypass traditional channels under specific scenarios. Due to challenges in regulation, liquidity, trust, scale, and technical security, these innovations cannot currently replace the dollar. They demonstrate a clear trend: the exploration of viable alternatives that do not rely entirely on the U.S. financial grid is actively underway. Crucially, the dollar's greatest challenge may not originate from external forces. The ultimate internal pressure facing the dollar system stems from the unique role the U.S. must fulfill. The essence of a reserve currency extends beyond economic scale or military deterrence. It depends on a highly scarce commodity, long term predictability. The world holds dollars because the United States offers the deepest capital markets, unparalleled treasury liquidity, a mature financial ecosystem, and deeply institutionalized trust. When a nation issues a standard currency, its monetary policy primarily impacts its domestic economy. But when a nation issues the world's primary reserve currency, every fiscal, trade, monetary, and foreign policy decision is scrutinized globally. Tariff policies, sanctions, debt ceiling standoffs, fiscal deficits, political polarization, and policy reversals might be standard features of domestic political discourse within the US, but to global markets, they translate into a very practical question. Is the long term cost and risk of holding dollar assets shifting? The dollar remains dominant today because America's market depth, innovative capacity, military power, and financial influence are unmatched. Yet, a reserve currency carries a unique burden. With great capability comes an even greater demand for stability from the outside world. The dollar is not a conventional currency. It is the primary collateral of the global financial architecture, the universal unit of account for world trade, and the core asset on central bank balance sheets globally. Consequently, American domestic policy is never just a domestic issue. It directly calibrates the global risk pricing of dollar assets. If policy uncertainty rises in Washington, the dollar will not be abandoned overnight. But global investors, central banks, and sovereign wealth funds will gradually demand a higher risk premium. This is the true internal pressure facing the dollar system. It is not an abrupt collapse of credit. Rather, it is the reality that the United States must pay a higher global cost for its own domestic policy unpredictability. Ultimately, the core question is not whether the dollar will collapse tomorrow, an approach that is far too sensationalized and oversimplified. The real question is whether the dollar's global status is America's ultimate privilege or its ultimate responsibility. The answer is likely both. The dollar provides the United States with exceptionally low borrowing costs, immense global purchasing power, deep financial markets, and unparalleled geopolitical leverage, the so called exorbitant privilege. Yet every privilege demands a trade off. As the world's currency, it no longer serves America alone. It must facilitate global trade, satisfy reserve demands, support international financing, and act as a global safe haven. This forces the U.S. to absorb complex structural strains alongside its advantages. It must continuously supply safe assets. It must maintain unwavering global trust in its markets and debt. And it must manage the internal pressures of debt expansion, persistent trade deficits, industrial hollowing, financialization, and domestic wealth inequality. While these challenges are not exclusively driven by the dollar, globalization, automation, technological disruption, corporate profit maximization, and policy choices all play major roles. The dollar's global hegemony undeniably amplifies these trends. It has concentrated massive rewards within Wall Street, multinational corporations, and high margin sectors, while leaving traditional industrial regions, blue collar workers, and ordinary households to bear the direct costs of global competition and structural economic realignments. The true moat of the dollar is not merely American power. More importantly, the world has yet to build an alternative framework capable of simultaneously providing the same scale of safe assets, depth of financial markets, liquidity, and universal global acceptance. We are moving toward a more fragmented, cautious, and risk conscious world. This is the true reality of the dollar system today. Powerful but heavily burdened. Stable but accumulating systemic pressure. What lies ahead? No one can provide an exact answer. The story of the dollar is far more than a story about money. It is the story of America's economic DNA, the global trade architecture, the international political order, and the very cost of living for everyday people around the globe. That's all for today's video. If you enjoyed it, please like and subscribe. See you in the next episode.